Hey, what's going on YouTube, and welcome back to Tech Conversations. As always, I am your host Guillermo, and as always, I am not a financial expert nor licensed professional. If you plan on investing in the stock market, please consult with one first and invest at your own risk. So I hope you're having a great day today. It is September 26th. I hope you've all had a great weekend so far. In today's video, I want to show you guys how you can sell a covered call without having 100 shares of the stock. Now, a lot of you guys have been asking me this question, and there is a way to go around that and basically almost make the same amount of money that you could potentially make if you did have 100 shares and sold a covered call. So I'm going to be showing you guys an example and explaining to you guys how this works. Now, before I get into that, all I ask from you guys is that you hit the like button down below and subscribe, guys. It really helps out my channel, and it really helps these videos become more widespread on YouTube, so that hopefully more people can watch them, learn more about investing in the stock market, and hopefully become better investors. Also, guys, check out the link in the description below to my Discord. We do have over 4,000 members. If you'd like to join, go ahead and click it. We have a bunch of great traders in there and a bunch of great resources, so come join us. So this is actually going to be called the poor man's covered call. And the reason it's called the poor man's covered call is because we're not going to need as much capital as we would need with your regular covered call. Because remember, in a regular covered call, you do need to own 100 shares of the stock to sell the covered call. In this scenario, you're not going to need 100 shares of the stock. You're going to need less collateral. And so that's why it's called the poor man's covered call. And so the first thing you're going to want to do is actually find a stock that you're bullish on, that you believe will go up in price here in the near term future. And so let's say, for example, I'm bullish on American Airlines. I believe that the price is going to go up on this stock. Well, here's what we're going to do. We're going to go into the options here for American Airlines. And so here are the options for American Airlines. So again, remember, on Robinhood, right, you can sell covered calls. However, since I don't own 100 shares of American Airlines, I can't sell this call, right? If I tried to sell this call, for example, and I went over here and I said, hey, I want to sell one contract, guess what it's going to say? It's going to say, hey, you don't have enough shares, right? You don't have enough shares of American Airlines for the collateral that's needed to sell this contract, which is true, right? That's how covered calls work. You need to have 100 shares of the stock. Well, we're going to do something that mimics almost that exact same thing. And so once you found the stock that you're bullish on, that you believe will go up in price, here's what you're going to do. You're going to first buy a deep in the money call at a later expiration date, usually a month to 2 months out. Okay, so let's leave it as 2 months out. So it's September 26th today. Let's go 2 months in the future. So closest thing to that is November 20th. Okay, we're going to choose that as our expiration date for the call we're going to buy here. And the next thing you're going to want to do is you're going to want to find a contract where delta, remember delta is one of the Greeks, is close to 1. And so, usually anywhere from, 0.9 to close to 1 is good. And so if we look at this $5 strike price, delta is 0.9632. So this is a pretty good candidate for that. And here's why you want delta to be close to 1. Because that's going to mimic you owning 100 shares of this stock, right? Because remember, in a covered call, you do have 100 shares of the stock. And so whenever that stock goes up by $1, since you have 100 shares, you're basically going up by $100, right? You're making $100. Same thing here, because remember, delta is how much the value of this contract is going to make, or in other words, how much you're making every time the share price goes up by $1. So if American Airlines right now went up by $1 to $13.60, the value of this contract would go up by this times 100, because remember, 0.9632 per share, but there's 100 shares here, so that'd be $96.32. So if this went up by $1, you're making $96.32. Very similar to when you own 100 shares and you sell a covered call. If it goes up by $1, since you have 100 shares, you're going to go up by $100. So again, this mimics you pretty much having the 100 shares. Okay, and so that's why you're gonna want to find a contract here where delta, I said, like I mentioned, is anywhere between 0.9 and then as close to 1 as possible. So this is a pretty good candidate. So we're gonna buy this call right here. So I'm gonna click on this plus sign. Okay, cool. Now we're gonna go sell our covered call, and so this usually should be a weekly thing, and so I would select the next weekly option, which is October 2nd, and then I can sell, whatever strike price I want here. And of course, since you're bullish, you're going to pick one of these up here. So let's say that I don't think American Airlines will be above 14 by October 2nd, but I do, I'm still bullish on it. So I could sell this call right here. And remember, when you sell a call, you receive a premium. I'm receiving 17 cents a share, and there's 100 shares in this contract. So I'm going to receive $17 for selling this covered call. And so I can sell this covered call here. And so now it's going to be custom. And I can say, hey, I want one contract here. And as you can see, this is going to cost $7.30. So I can go to review order. And as you can see now, here's my order summary. I'm buying to open a $5 call, right, expiring on November 20th. And then I'm going to sell to open a $14 strike call expiring on October 2nd. Now, this is how you would set it up, but let's actually see how this would look like. Okay, and to do that, we're going to go over to the options profit calculator. And remember, this is a great tool to visualize what's happening in this trade. Okay, and so what we're going to do is we're going to go over to custom, and we're going to go to 2 legs here, because that's what we did over there. And so we're going to put in the symbol, which was American Airlines, AAL. We're going to get the price, which is $12.29. And then we're just going to insert what we pretty much did here, right? So we bought to open a $5 call, then we sold to open a $14 call. So let's first buy the call, which again was expiring on November 20th. So that is right here. Remember, we bought the $5 strike call. Calls are on the left, puts are on the right. Don't get that confused. So we're going to click on that. So we're buying this call here, which is going to cost us $738. And then remember, we're selling our call as well, or writing it. And this was on October 2nd. And this was at a 14 strike price, if I'm not mistaken. Yep, 14 call. And so here's the $14 strike and the $17 here. Okay. And so let's graph this, and let's set our graph range of 18 to 1450. So let's calculate this. So here's what this looks like, right? And so our max risk is 721, or basically, what we're paying to enter this trade, right? And so, which makes sense, right? Because we're pretty much buying a call, and then we're getting some premium back from selling the call, which pretty much means we're paying 721. And of course, if this ends up expiring worthless, we lose all our money, which is 721. So it's the most you can lose here. Okay, but look at this. Remember, this works when you have a bullish sentiment on that stock. And so as you can see, as this goes up, we're making good money. Now, your profit is capped, right? Similarly, as you can see, our max return is going to be $183 at $14 at expiration, right? Why 14? Because that's the call, that's the strike of the call that we sold. Remember, what that basically says is that, hey, if it goes above 14, or remember, in a regular, covered call, if it hits that strike price, that's the price. If it goes above that strike price, that's the price that you're going to sell your shares at. So it makes sense that at $14 is where your profit is capped. And so as you can see, your max return would be $183 at $14 at expiration. So this is pretty cool, right? You can look at the price of the stock, and then the what date it is, and you can kind of get an example of how much you would be making. Right, so as you can see, this is a bullish strategy. You do want the price to go up. If it starts to go down, obviously you're going to be losing money. Now let's compare this to an actual covered call. So on the right over here, I actually have that covered call. Uh, and so in this scenario, this is an actual covered call. So we're assuming we're buying 100 shares of American Airline at the current price, which is $12.29. So our total cost would be this. And then we're writing the same call that we wrote over here. As you can see, on October 2nd at a 14 strike, we're receiving $17. So let's compare this. Okay, so our max risk, as you can see over here, is actually more, which makes sense because of American Airlines, if the price of the stock of American Airlines goes down to $0, right, you're going to lose a lot more because you paid $1,229 for it and then you received $17. So this is how much your max risk is. So your max risk is actually less in the poor man's covered call, again, which would be 721. However, your max return on the covered calls is going to be a little bit more, but not a whole lot more. Okay, just a little bit more, as you can see here. Your max return in this scenario would only be $188, again at the price of $14 at expiration. Because again, remember when you sell a covered call, the strike you choose on the call you sold is basically saying, hey, if it goes above that price, that I'm going to be forced to sell my shares at $14 a share, right? So your profit there gets capped. But as you can see, look at these graphs. They're very, very similar. Okay, and I'm not going to go through all of this, but I encourage you guys to come and graph it out here on the options profit calculator. This is a real, actual covered call. This is the poor man's covered call. As you can see, it's very, very similar, right? The only different being that, again, over here on the covered call, you're usually going to make a little bit more money. Your max return is going to be a little bit higher. But the good thing with a poor man covered call is you're going to need less capital, right? You don't need the 100 shares of the stock. You just need to buy a very in-the-money call. So your capital requirements are going to be less, which means your max risk is also going to be less, right? Comparing it to the max risk over here. Of course, one bad thing about the poor man's covered call is, if the price moves against you, right? If American Airlines actually goes down in price, and it doesn't move up until expiration date on the call you bought, that's actually money that you're going to lose, right? Because it's an option. Where in this scenario, if American Airlines goes down, well, you own the 100 shares of American Airlines. You can just hold them and wait for the price to go back up eventually, right? And so, that's kind of the only downfall, in my opinion, is, if it moves against you over here, you're actually going to lose that money because, again, it's an option. Where over here, if it moves down, then that's fine. You still have the 100 shares of the stock. You just wait it out and wait for the price of the stock to go back up. So that's the poor man's covered call. Again, I encourage you guys to come into the options profit calculator and play a little bit more with it. But again, it mimics very closely an actual real covered call without actually needing 100 shares of the stock. So I hope this all makes sense to you guys, but if you guys have any questions at all, feel free to leave them in the comment section below. Again, guys, if you'd like to join my Discord, link to it is in the description below as well. If any of you plan on using Robinhood in the future, feel free to use my referral link. I'll put that in the description below as well. If you sign up using my referral link, both you and I will receive one free stock, which is free money for both of us. So I hope you enjoyed the video. Let me know what you guys think, and I will see you guys next time.